The Bank of Canada has just made floating rate borrowing 50 basis points more expensive. We're going to talk about that and what's coming in 2023 next on MortgageLogic.news. Bank of Canada kept its foot on the economic brake by boosting our overnight rate aggressively. It was a seventh straight rate increase. Banks should lift prime to 6.45% effective tomorrow. The good news is that inflation seems to be heading in the right direction, though. 3-month annualized inflation, which the Bank of Canada watches like a hawk, is easing. And we're approaching very tough monthly inflation comparables in the first quarter. That should counter inflation psychology, if nothing else. Now, the Bank of Canada says it's considering whether more hikes are necessary, and that's a difference from its prior statements, which suggest they will hike further. That's a key change. The yield curve, meanwhile, is pricing in imminent recession, and our latest rate simulations based on the bond market's implied rate path suggest a short-term fix will therefore outperform all other mortgage terms. That hypothetical is not without risk, however. Q3 GDP was double the Bank of Canada's forecast. The job market is still hot and financial conditions are easing, which makes the bank's job tougher. As we've written in the past, abnormally high inflation has a half-life of at least a few years historically, and that means inflation of almost 7% could potentially take into 2024 to fall into the low 3% range. Now that in turn suggests a fair chance that inflation could overstay its welcome, meaning a 2-year fix is probably the safer of the short-term rate plays for borrowers with less ability to withstand interest risk. That's it for today, folks. Visit us at mortgagelogic.news for weekly mortgage analysis. Have a fantastic holiday season, and thank you for watching.